A lot of traders lose money when it comes to trading chart pattern and blame it on retail trading. That's absolutely wrong. In this video, I'm going to show you exactly what chart patterns are, how to spot them, how and when to trade them, right? And I'm going to show you the common mistake most traders make that leads them to the conclusion that chart patterns are meant for retail traders. Meanwhile, everything I teach in this video has been put together in my complete chart pattern playbook. It's totally free. If you're interested in that book, use the link in the pinned comment or description below to get the book. So let's get started. What are chart patterns? So chart patterns are simply area of consolidations that shows us the potential direction of the market, either to the upside or to the downside, right? So when market makes a move, let's say market makes a bullish move, it consolidates, right? So chart patterns are recognizable patterns that indicates the potential direction of the market. So is the market going to go up next, or is the market going to go down, right? It gives you an insight to determine the next direction of the market after its initial move, right? So similarly, when price moves to the downside like this, we get consolidations, right? So these consolidations can sometimes form recognizable pattern that gives us an idea of the next direction of the market, either going downwards or going upwards. Now, how do we spot and trade chart patterns, right? So this is one of the most important aspect of this video, concept of this video, right? We spot chart patterns simply by watching out for the preceding move leading to an area of consolidation, right? So when you want to spot chart patterns, all you have to do is, first of all, watch out for the trend. Is the trend bullish? Is the trend active? Did we just have a massive bullish move to the upside or a massive bearish move to the downside? When you determine this, then you watch out for the consolidation after those moves. And this consolidation gives you an insight on what's going to happen next. So I'm going to give you an example. So let's say, for example, you're watching a chart and it creates higher highs and higher lows. There's a basic way to determine market direction, right? So if you get highs and higher lows like this, then we get a consolidation, right? So this consolidation can sometimes be referred to as chart patterns, and there are different types of chart patterns, right? You get symmetrical triangles, ascending triangles, you get bullish flags, bearish flags. So this is exactly how you spot these chart patterns when you open your chart, right? You first of all take a look at the trend. When the trend is bullish, for example, you watch out for consolidations, and if the consolidation creates a recognizable pattern like a bullish flag, symmetrical triangle, ascending triangle, then oh, this is a chart pattern, and now I'm looking forward to opening my positions or looking forward to going long in line with the trend. So chart patterns act as two major things, right? They can help you spot potential entry, right? They can help you enter your trades early because they already tell you the potential direction of the market, and they can also help you understand when to stay away from the market or when to trade the opposite direction of the market, right? So even if the market is bullish, a chart pattern, if it's a reversal pattern, it can indicate potential price levels where you are likely going to see a change in trend, right? But each chart pattern has its own explanation as to what's going on. So we're going to take a look at some of these, right? But I have a complete trading system, right? A complete price action trading system that explains all this deeply. But we're going to take a look at a few today in this video. So this is exactly how to spot chart patterns. Now, how do you trade chart patterns? You trade chart patterns simply by going in line with the trend. So here's a chart on gold, right? So we have a chart on gold right now on the 1 hour time frame, right? Now, if you take a look at the movement all the way from these lows to these highs, you would notice something creating higher highs and higher lows. So this is clearly a bullish trend, right? Now, just see, we have a chart pattern here, right? So this is known as an ascending triangle, right? So this is an ascending triangle. This means we have bulls mounting pressure towards an area of resistance, right? So we have an area of resistance here trying to prevent price from climbing higher, and we have price creating higher lows. So this is an ascending triangle, right? So the psychology behind this pattern is that we have the bulls mounting pressure towards an area of resistance, and your trigger to go long or your trigger to enter this trade would be watching out for a breakout above the area of resistance. The reason is because this chart pattern already tells us that bulls are in charge. Bulls are mounting pressure towards the area of resistance. So when we get a breakout above that area of resistance, then it's a go to go long, right? Now, this is how you trade chart patterns. Chart patterns should always go in line with the preceding trend. in line with the preceding movement. And in this case, we have a bullish move to the upside like this. Then we have this consolidation, which gives us a chart pattern called an ascending triangle, which means bulls are in charge, and we had a breakout. So the moment of entry would be after price breaks out from this area of resistance. You can even go as low as a 30 minutes time frame to take trades like this, right? So another example would be this. If you take a look at this price action we have over here, right? We have a bullish market structure, price going higher. You can see we have an area of support, and we have this bearish pressure mounting towards the downside. So now in this case, some traders, right, some traders would, you know, want to go short because they feel now this is a descending triangle, right? So a descending triangle usually means bears are in charge because they are mounting pressure towards an area of support, and when you get a bearish breakout, you go short. This is where most traders get it all wrong, right? Chart patterns should first prioritize the trend in which they are formed. In this case, they are formed in a bullish trend. So just because the pattern shows us that bears are mounting pressure towards an area of support, there's a good chance we go lower, doesn't mean that is the right decision. So for situations like this, you ignore a breakout from the support because, right, they are best traded when they go in line with the preceding trend. That's why so many traders, when you get set up like this, they fail to acknowledge the trend and they want to go short here because the chart pattern says bears are in charge over this consolidation. They are mounting pressure toward the support, and if you get a bearish breakout, go short. So they go short immediately, and you see they get wiped out. So the reason why you don't do this is because the trend, the preceding movement, supersedes or dictates what that consolidation means. And this consolidation can give you a breakout in two directions, right? So over here, we didn't get a clear breakout to the upside, so you wouldn't have probably gone long, but you would have avoided going short here because the preceding trend is bullish. This is how you trade chart patterns. You don't just jump into chart patterns because you had a breakout from a support level and this detailed bear is a mounting pressure towards the area of support, right? But you can see in this case, the same situation applies here. Bulls mounting pressure towards an area of resistance. A good breakout above the area of resistance means go long. This is valid because it aligns with the preceding trend, which is bullish. So you want to always be in line with the trend, and chart patterns can help you decide when to go long. And in this case, you go long after the breakout. So another example would be over here, right? You can see this is a USD CHF chart on the 1 hour time frame. Now, why is this valid? You can see this is an ascending triangle, right? So over here, you can see the preceding movement before the formation of this chart pattern, which is an ascending triangle. It's a bearish movement, lower highs, lower lows, right? The overall trend, if you zoom out, is a bearish trend. You can see this massive bearish move to the downside, consolidation, and now one over here. So this is simply a continuation. So chart patterns should mostly be used as a continuation pattern. So we have continuation patterns, we have reversal patterns. Like I said, if you want to go into detail what these different patterns signify, I have everything explained in my complete price action trading system, right? You can check that out with the link in the description below. So you can see we have bears, so we have bulls mounting pressure towards an area of resistance, but that doesn't really mean much, right? We only know bulls over here are in charge. That's what this consolidation means. But at the end of the day, the bulls capitulated and the bears took control. That's why we had this breakout down, and it aligns with the preceding movement following the consolidation or following the chart pattern. So the right thing to do is go short, and you can see in the morning, right? I'm going to show you another example. Different pattern, same chart, USD CHF, right? Now we have a symmetrical triangle. So symmetrical triangle usually dictates that price could break in either direction, right? Price could either go up, price could either go short, right? So we get a bearish breakout or a bullish breakout because this means indecision. Bulls mounting pressure towards the upside, bears mounting pressure towards the downside, so which gives us a tight range, right? So now, if we get a bullish breakout to the upside, you should ideally go long. And if you get a bearish breakout to the downside, you should ideally go short. But in this case, you ignore because the preceding movement over here is unclear. You can see we have 1, 2, 3, 4. So we have higher highs and higher lows, right? But if you take a look, this is also in a macro downtrend. The overall trend is still bearish, right? So how would you know the direction to take, except maybe you want to scalp, right? If you want to scalp for 10-20 pips, then fine. But most traders, when you open a trade like this, your TP wants to be placed around its highs, right? Your TP wants to be placed around its highs, and after the breakout, you go long, aiming for this price level, and you can see we just moved down and just kept going sideways. So when chart patterns are formed within a consolidation, you ignore them completely. That's another mistake most traders make, right? They just look for chart patterns anywhere on your chart as long as it resembles a bullish flag, a rectangle, a bearish flag. They want to go short or go long. That is not how you trade chart patterns. Chart patterns formed within an area of consolidation, a huge consolidation like this one over here, are meant to be ignored. You should only focus on trading chart patterns that are in clear trends. For example, the one we took a look at here on gold, right? Another thing to also note is chart patterns are not always predefined. So just because you know a descending triangle dictates that the bears are in charge, bears are mounting pressures on area of support, so go short here. This would be valid if it was in a bearish trend. But if we're in a bullish trend, chart patterns can break in either direction, either to the upside or to the downside. So when you do something like this, going short in a downtrend, in a bearish trend, where you could even have a layer of liquidities that could push price higher, that's where you get tagged as being a retail trader, because you are not watching out for the most important information on the chart. So chart patterns are simply consolidations, right? A breather. So market goes up, for example, market does not go up in a straight line, price does not go up in a straight line. So market goes up, it consolidates, right? And it can either go down or go up. This consolidation is what we call chart patterns. They are chart patterns only when they are recognized, right? So you could even get consolidations that are not recognized. Let's say, for example, let me look for one on the chart. Okay, this one, for example, right? This is just a normal consolidation, right? It's just a consolidation. So I don't think there's any recognizable pattern. This is not a bullish flag. This is not a bearish flag. This is not a descending triangle. This is not an ascending triangle. It's just a consolidation. But you can see this one is recognizable. That's why we call it chart patterns, because we know when we get our breakout, it gives us an opportunity to go long. You can see this one is an ascending triangle. It's a recognizable pattern. That's why we call them chart patterns. But they are ideally just consolidation, a breather before price continues going in its original direction, right? So one last example before we wrap up this video. You can see we have one here, right? So this is a clear symmetrical triangle, unlike the one we had on USD CHF, right? So you can clearly see the difference. The difference is this one is formed after a bullish move. So the preceding movement is clearly bullish, right? The overall trend is clearly bullish. So when you get patterns like this, these act as a continuation, right? So when you get a pattern like this, immediately we break out from this pattern, from this consolidation, it means the market has decided on a direction it wants to head, and you just go long after the breakout. Stop loss will be placed underneath the consolidation, and your take profit target could be as high as, 1:3 or 1:2. Get depending on how wide your stop loss is, right? So that's it briefly for chart patterns, what they are, how to trade them, how to spot them, and the misconception about chart patterns that most traders overlook. Chart patterns should be traded in line with the trend. They are not meant to be isolated and traded alone, right? So like with the example we had on USD CHF. Don't trade chart patterns that are formed within area of consolidations, because you need context, right? And that context should be the trend preceding the formation of those patterns. So once again, everything I just talked about in this video, I have more them detailed out in my book. The chart pattern playbook is totally free. Use the link in the pinned comment or description below to get that book. And if you want solid insights on how I trade price action, get the best results, spot solid trade opportunities, you can also check out my complete price action trading system, right? I have the link attached in the description, pinned comment as well. That's from me in this video, guys. See you in the next one.